Welcome to the Deep Dive. We're here to cut through the noise, get straight to the insights you need. Today, we're taking a really deep dive into something pretty empowering, financial independence, or FI, our mission. Well, it's to demystify what FI truly means, help you figure out your own personal FI number, and maybe most importantly, understand the core principles and strategies to actually get there. We've looked at quite a range of sources, financial calculators, big academic studies like the Trinity study, insights from advisors, even this interesting algebra of wealth idea from an entrepreneur. The goal here is to give you a clear, actionable roadmap, move you from maybe feeling a bit overwhelmed by all the jargon to feeling confident about your own path, your path to financial freedom. Okay, so let's unpack this first. What is financial independence, really? I mean, it's got to be more than just having a massive pile of cash, right?
Oh, absolutely. It's definitely more nuanced than just a huge bank balance. Basically, financial independence is that state where you or your household have enough financial resources built up, enough to cover your living expenses.
Definitely.
And you can do that without needing traditional employment.
Indefinitely. That's the key word there.
Exactly. And the really profound part, I think, is that it's fundamentally about freedom. Freedom to make choices. It lets you pursue goals, dreams, maybe give back to the community, or just have peace of mind, without constantly worrying about earning the next paycheck.
So it doesn't automatically mean you stop working entirely?
Not necessarily, no. For some it might, but for others, it just transforms their relationship with money and work. It frees you from debt, frees you from feeling pressured into maybe poor financial decisions just to keep an income. And it's quite subjective, too. You see folks in the FIRE movement, financial independence, retire early. They practice pretty frugal living to get there much sooner. Others aim for it more like a traditional retirement.
That makes a lot of sense. So, okay, freedom's the goal. How do we actually figure out our specific number? You mentioned our sources have a few different ways of looking at this.
Precisely. Yeah, let's break down some methods to find your target.
Yeah.
The absolute cornerstone is figuring out your target amount based on your expenses. The core idea here is simple. How much wealth do you need? So the passive income it generates can cover your expenses forever or, for a very long time.
Okay, so start with expenses.
Right. And you need a really comprehensive look at your annual living costs.
Mm-hmm.
Housing, transport, healthcare, food, fund money, everything. Obviously, if your annual expenses are, say, $60,000, you're going to need a bigger target than someone who only needs $40,000 a year.
Makes sense. What else goes into that calculation?
Well, then you have your withdrawal rate. That's the percentage of your investments you plan to safely take out each year without, running out of money. A more conservative rate, like maybe 4%, means you need a bigger pot to start with compared to a slightly more aggressive 5%.
Okay, expenses, withdrawal rate.
And you absolutely must factor in inflation. If you ignore it, you'll underestimate how much you need because things get more expensive over time. If inflation runs at, say, 2% a year, your costs are just going to keep climbing.
Right. That $40,000 today won't buy the same amount in 20 years.
Exactly. And finally, investment returns. What you expect your money to earn. Higher projected returns could shorten your timeline. Lower returns mean you need to save for longer or save more. What's really fascinating is how all these pieces, expenses, withdrawal rate, inflation, returns, they all interact to create your unique target number.
Okay, that's the detailed expense-based way. What about the other approaches? You mentioned something about income multiples.
Yeah, that's another way to look at it. Thinking about your net worth as a multiple of income. It's a quicker way to gauge where you are, especially maybe earlier in your career. There's this sort of magic number people talk about, often around 10 times your annual income and net worth for financial independence.
So if I make $100,000, I'm shooting for a $1 million net worth, roughly.
Roughly, yeah, by that metric. So if you earn $200,000, maybe $2 million. But it's useful to think about mile markers on the way, like getting to 1x your annual income and net worth. That's like critical mass. You're really in the game then, building momentum. Then maybe around 3 to 5 times your income, progress can feel pretty fast. Your savings are doing a lot of the work.
Okay.
Then, between 5 and 10 times income, that's often where investment returns really start to take over from your savings rate. It's interesting. Sometimes it doesn't feel like you're making huge leaps then, but the compounding is working hard.
And beyond 10x.
That's when the really exciting what-ifs start appearing.
Mm-hmm.
What if I took a sabbatical? What if I switched to part-time? You start feeling truly in control.
That 10x benchmark is interesting. I wonder, though, do people sometimes get stuck, say, between that 5x and 10x range? Does it feel like a slog?
That's a great point. It can feel that way sometimes because the contribution from your savings becomes a smaller percentage of the growth compared to the investment returns.
Right.
But that's actually a good sign. It means your money is really working for you. It's also a bit of a psychological shift, seeing your assets grow significantly on their own. And then there's a third perspective, comparing your potential future earnings versus your investment portfolio.
How does that work?
This shifts the focus away from just income multiples and onto the actual portfolio you could live off. You estimate your future earnings, maybe simply your current salary times the number of years until you plan to retire, say 65. So take someone who's 42 earning $270,000. They have 23 years until 65. Multiply those.
Yep.
That's potential future earnings of about $6.2 million. Now, here's the comparison. If your current investment portfolio is already more than that $6.2 million, well, your money is effectively working harder or has more potential than your future salary does. By that specific metric, you could argue you're already financially independent. It really frames the trade-off between working longer versus living off your assets.
Wow, that's a powerful way to think about it. Okay, let's shift gears a bit. This next topic gets a lot of attention, the safe withdrawal rate. This seems like where the plan really meets reality, right? Making sure the money lasts.
It absolutely is. The safe withdrawal rate, or SWR, it's basically the percentage of your savings you can take out each year for retirement without, fingers crossed, running out of money. You might hear finance folks talk about avoiding superannuation. That just means outliving your money.
Right, the big fear.
Exactly. And the most famous concept here is probably the 4% rule. Came out of work by Bill Bengen back in the 90s, part of the Trinity study research. The idea was you could withdraw 4% initially, he said, maybe 4.2% of your portfolio's value in first year of retirement. Then you adjust that dollar amount for inflation each year after. And the goal was to make the money last for at least 30 years.
And how is that held up?
Remarkably well, historically speaking. Michael Kitts is a well-known financial planner, points out that looking back over the last 150 years of market data, there hasn't been a single 30-year period where following the 4% rule with inflation adjustments would have caused someone to run out of money in under 30 years.
That is pretty incredible. A really strong historical track record. But, okay, you mentioned inflation adjustments. That's built in. People worry about that.
Yes, that's a crucial point people sometimes miss. The 4% rule does account for inflation. So, using an example, let's say Heidi wants $40,000 in her first year. If inflation is 2% the next year, she takes out $40,800. If inflation hits 3% the year after, her withdrawal becomes $42,024. It's designed to maintain her purchasing power.
Okay, good.
No.
But what are the risks? It can't be foolproof.
No, definitely not foolproof. A major threat is something called sequence of returns risk. This is the danger of hitting a patch of really bad market returns right at the beginning of your retirement when you start withdrawing. It can deplete your portfolio much faster, making it really hard to recover even if markets bounce back later.
Right. Bad luck early on can really hurt.
It really can. That initial period is critical. And also the 4% rule was based on a 30-year retirement. What if you retire early or just plan for longer? For a portfolio to potentially last, forever or certainly longer than 30 years, some experts, like Kitz's, again, suggest maybe lowering that initial rate, perhaps down to 3.5%.
So 4% is a good guideline, but maybe be a bit more cautious for longer timeframes or if you're risk averse.
That's a fair way to put it. And there are other strategies, too.
Yeah.
Things like variable withdrawal rates, where you take out a bit more in good years and tighten the belt in bad years, or methods like the Guyton-Klinger rules, which have guardrails. Fidelity, for instance, uses what they call a possible sustainable withdrawal rate as one of their key planning metrics.
And does that rate change depending on where you are?
Interestingly, yes. Their research shows variations based on region, likely due to different expected investment returns, inflation assumptions, maybe even typical retirement lengths. For example, they might estimate 5.0% for the UK, 4.5% for the US, maybe 3.9% for Japan, 4.1% for Hong Kong. It really highlights that you need to tailor your plan to your specific context.
Yeah.
A single global number doesn't quite work.
That's fascinating. It shows how local conditions matter. So while 4% is maybe the safest bet,
It's generally seen as the most robust starting point, yes. But some advisors might use 5% as a, let's say, solid planning number for clients who maybe have a higher risk tolerance or perhaps other income sources, balancing that sustainability with enjoying retirement a bit more.
okay, that makes sense. So calculating the numbers, understanding withdrawal rates, that's one huge part. But then there's the other side. How do we actually build the wealth to get to that number in the first place? You mentioned an algebra for getting rich.
Right, exactly. We can look at this through the lens of Scott Galloway's algebra of wealth. He frames it as wealth equals focus, multiplied by the product of stoicism, time, and diversification.
Okay, break that down. Start with focus.
So focus. Galloway argues it's less about raw talent and more about sheer determination and focused effort. It's about finding something you can become truly great at and something people will pay you well for. Interestingly, he suggests it doesn't even have to be your initial passion. Sometimes becoming excellent at something valuable makes you passionate about it.
So find your niche and excel.
Pretty much. And position yourself for success. That might mean getting specific certifications, maybe moving to a city with more opportunity or competition that pushes you, or identifying and riding a growth wave, like he mentions getting into e-commerce early on.
Makes sense.
And
What else falls under focus?
he also puts a huge emphasis on investing in the right relationships. He argues, and research tends to back this up, that the single most important economic decision you make is choosing your life partner.
Really, an economic decision.
Sounds maybe unromantic, but statistically, married individuals tend to see significantly greater increases in net worth per person, something like 77% more, according to one study he cites, compared to single folks. And how do you nurture that valuable relationship? He stresses things like forgiveness, generosity, just consistently showing up and being engaged.
That's a really powerful perspective, linking relationships directly to financial well-being. Okay, so focus is about skill, strategic positioning, and relationships. What's next in the algebra? Stoicism.
Exactly. Stoicism and discipline. This is where the saving and spending habits come in. Galloway calls living below your means the clearest blue flame path to financial freedom. Hammers home the point. It isn't your salary that makes you rich. It's your spending habits.
Can you give that example he used?
Yeah, it's a dark one. He contrasts an investment banker earning millions but spending it all on alimony, fancy cars, lavish lifestyle. That person is effectively poor, despite the high income. Then he compares that to his father, living on maybe $50,000 from a pension and Social Security, but only spending $40,000. That $10,000 surplus makes him rich in the sense of building security.
Wow, that really flips the script on what rich means.
It does. It shows the most powerful predictor of your future financial freedom isn't how much you earn, but how much you save. And this ties into temperance, discipline, resisting that constant urge for consumption, differentiating clearly between an investment, something that enhances your future economic security, and consumption, something that gives you maybe a short-term dopamine hit but doesn't build wealth.
That distinction is key, isn't it? Thinking about where our own spending falls on that spectrum. Investment versus consumption.
Absolutely.
Right.
It's something worth reflecting on. What stands out to you about that distinction in your own life? It's a constant balancing act.
Definitely food for thought. Okay, so we have focus, stoicism, discipline. What are the other multipliers?
The next big one is time and compounding. Time over the long haul is arguably your most powerful ally in wealth building. You just can't afford to squander it. The advice is simple but profound. Invest early and make it a habit. The math behind compound interest is just relentless.
Can you share that example comparing the early investor versus the later one?
Yeah, it's incredibly illustrative. Imagine two people, A and B. Both invest $4,000 per year. And let's assume they both get a 10% annual return, just for the example. Person A invests that $4,000 every year starting at age 20, but stops completely at age 40. So 20 years of investing. Person B starts at age 40 and invests $4,000 every year until they're 65. So 25 years of investing, longer than person A. But who ends up with more? Person A, the early starter, ends up with something like 600% more money than person B, purely because their money had those extra decades at the beginning to compound.
600% more, even though they invested for fewer years. That's staggering.
It really shows the power of starting early. It perfectly proves that old saying, it's time in the market, not timing the market, that truly builds wealth.
Absolutely compelling. Okay,
Yeah.
Focus, stoicism, time. What's the final piece of the algebra?
The final element is diversification. Galloway calls this your Kevlar, your financial body armor. Its purpose is to ensure that no single bad investment decision or unexpected market crash in one sector becomes a fatal blow to your overall plan.
So it doesn't stop you from taking hits, but it prevents a knockout punch.
Exactly. Like Kevlar, it won't stop the bullet entirely. Maybe you still feel the impact, but it stops it from being lethal to your financial health. He even shares a personal story. Buying Netflix stock way back when at maybe $12, selling it quickly at $10 for a tax loss, and then watching it soar, never getting back in. A potentially huge mistake, financially speaking.
Ouch.
Right. But because he was diversified, it was a painful mistake. but not a fatal one for his overall wealth.
Sure.
And the data backs this up strongly. If you'd simply invested in broad, low-cost index funds over the last decade or so, you likely would have outperformed the vast majority, like 90% of actively managed or alternative funds.
Right.
Plus, historically speaking, holding a diversified basket of stocks for a long period, say 20 years or more, nobody has ever actually lost money overall.
That's a reassuring statistic for long-term investors.
It is. So the practical advice is generally to avoid having too much, maybe more than 5% or 10% of your total net worth tied up in any single investment or asset class. Spread the risk.
Okay, so focus, stoicism, discipline, time, and diversification. That's the algebra. Now, bringing it all together,
Hmm.
what does this mean for your journey for the listener trying to put this into practice day to day? How do we apply these principles?
Right. It comes down to making it actionable. A few key strategies emerge, along with the need to keep adapting. First, you really need to define a clear financial goal. Don't just say, I want to be FI. Quantify it. What's your target amount based on those calculations we discussed? And set a realistic timeline. Maybe it's accumulate $1 million in investable assets within 20 years.
Get specific.
Exactly. Then you absolutely need to develop a comprehensive budget. Track your expenses relentlessly, see where the money's going, identify areas you can cut back, and then prioritize contributions towards your goal.
Budgeting not always fun, but sounds essential.
It really is the foundation.
Mm.
Alongside that, actively work to minimize debt, especially that high-interest stuff like credit cards. Every dollar not going to interest is a dollar you could potentially invest. And then, of course, maximize your savings and investment contributions. Make it consistent. Automate it if you can. Even small amounts add up significantly over time thanks to compounding.
What kind of savings rates should people aim for?
Well, guidelines vary. Fidelity's data for the U.S. shows average total contributions, employee plus employer match, in workplace plans like 401ks are around 13.5%. But their research actually suggests aiming for closer to 15% is often needed to maintain your lifestyle in retirement. In the UK, the auto-enrollment minimum is 8%, but again, Fidelity suggests something like 13% might be more realistic for a comfortable retirement. So aim high if possible.
Good benchmarks.
Yeah.
And investing those savings.
Yes, diversify those investments. Spread your money across different asset classes, stocks, bonds, maybe real estate depending on your situation, and risk tolerance. You can even think about combining different income streams in retirement. Maybe some rental cash flow, some stock dividends, maybe income from REITs or crowdfunding, some bond interest. For example, aiming for, say, $5,000 a month in passive income might involve a mix, perhaps $1,000 from rentals needing $250K invested, $1,000 from dividend stocks needing $300, and so on. It requires building up different pots.
Okay, diversify investments. What else?
A big one is manage lifestyle inflation. As your income grows over your career, resist the temptation to let your spending grow right along with it. Every extra dollar you don't spend is a dollar you can invest towards FI. And finally, this isn't a set it and forget it thing. You need to continuously educate yourself and adapt. Financial markets change, your life circumstances change, marriage, kids, career shifts.
So review the plan regularly.
Definitely. Review your calculations, ideally at least once a year. Adjust your strategy as needed. Financial advisors often recommend more comprehensive planning sessions, especially as you get closer, say within 10 years, of your target retirement or FI date. And we shouldn't forget the employer's role. Workplace retirement plans, matching contributions, clear guidance. These are really crucial, especially for big companies with diverse workforces. They help encourage that early, consistent saving habit.
So putting it all together, it's about having a strong plan, saving diligently, investing wisely, and staying flexible.
That sums it up pretty well. It's about establishing that strong plan, but recognizing there's always uncertainty, especially with markets. And really prioritizing saving consistently, not just hoping high investment returns will do all the heavy lifting for you.
Ultimately, it feels like the journey to financial independence. It isn't just about the numbers, is it? It's really about designing the life you want to live, empowering yourself to take control and gain that freedom.
Absolutely. And remember, while the math and the strategies give you the framework, the real prize, the true reward of achieving FI, is that freedom, the ability to choose, to work how you want, when you want, or not work at all, if that's your choice. So maybe as you reflect on all this, the most powerful question to ask yourself is, what's the one shift, maybe even a small one, that you could make starting today to accelerate your own path towards that freedom?